Welcome back. Stocks are efforting a rally this morning as we look ahead to a busy morning of retail earnings. Dow Industrial's up about 50 points right now. S&P up 6.25, and the NASDAQ right now higher by 18, reversing earlier and yesterday's losses. Burlington, Best Buy, Dollar Tree, Dick's Sporting Goods, all reporting their quarterly results this morning before the opening bell. And as you can see, the biggest mover this morning, you've got Burlington up better than 3%, Abercrombie & Fitch down better than 3%. Joining me right now is ProChain Capital President David Tawil. David, it's great to see you. Thanks very much for being here this morning. I want to get your take first on the macro story, what you're expecting from the retail sector, and your assessment of what you've heard so far regarding the consumer.
So the consumer is kind of caught between incredibly high prices at the grocery store and the desire to go ahead and get back out there after years of COVID and live a very normal holiday season. And I think there's going to be a tension there. However, I think the willpower of the consumer and the spending desire is going to win out, and we will see a moderately positive spending season all around retail today.
Thoughts on 2023? We've been talking about the potential for a rail strike this morning. No doubt that pushes inflation higher.
Oh, certainly. So first of all, before we get to the rail strike, though, remember that all this spending is going to need to be financed. And we've seen credit card debt skyrocket and certainly not keeping pace with wage inflation at all and real income at all. And so therefore, there is going to be a reckoning of this credit card debt at some point. And I think it'll start to stare people straight when losing jobs becomes a reality. Although we've started to see a bunch of cuts, it's mostly been around technology companies. I think we'll see them in earnest around all industries going into 2023. With respect to the rail strike, certainly this country does nothing except at times of emergency. We need to see sirens. We need to hear sirens blaring, and we need to see the red lights flashing. And I don't think we'll have a strike, although we're at the precipice of absolute disaster based on where we are right now. But I do believe that we will go ahead and get to some sort of reconciliation within the next couple of days.
Well, you hope so, because the unions have all the leverage now. They want, the last time we spoke with the unions on this program, they said they wanted sick days. They want paid sick time, and that was not in any deal. They kept pushing back. If we get sick, what about COVID? We're not getting paid for sick days. So that was one of the sticking points, but they have a raise in place of 24%. So whatever happens, a lot of other unions are going to want a 24% raise if, in fact, that deal sticks. So this, do you see this as a catalyst for other labor unrest?
Oh, certainly. I think that we've seen unionization happening across the board in places that we never saw before, like Amazon and Starbucks. So certainly there is a renaissance in organized labor, and having been an investor in a number of companies that were unionized in terms of the employee base, and multiple unions at that in my history as an investor. Certainly, these are not easy negotiations. Certainly, what the unions ask for on paper sound incredibly sympathetic, and so therefore it is often very hard at times to go ahead and reconcile. And frankly, you hit on a very important point, which is they ask for prediction for the future, well into the future, right? They're asking for raises going forward for a number of years. And we don't know where a lot of these industries are going to go, especially some of these old line industries, which are being replaced by technology. And so therefore, the base of employees is not growing over time. It's actually shrinking. And so therefore, it's going to be harder and harder to keep up, especially with the pension benefits that are demanded by the union going forward.
Yeah, it's a great point. Let me get through a few more real quick news items. Disney, David, Bob Iger wasting no time restructuring Disney since his return as CEO 24 hours ago. He told employees yesterday, "We will begin implementing organizational and operating changes within the company. It is my intention to restructure things in a way that honors and respects creativity." His first step was letting go the head of media and entertainment, and that, of course, was Bob Chapek, his predecessor's right-hand man, Kareem Daniel. David, any thoughts on Disney? The stock is down about pretty significantly year to date, but, of course, had a bounce yesterday on this news.
I think Disney is in an incredibly risky position right now. They've painted themselves into a corner based on a lot of the woke activity, based on a lot of the bad press going around with regard to the parks. And frankly, it's been a very difficult operating environment for them. I think Iger is master of media, but at the same time, he was the leader at a very specific time and championed that time. To go ahead and place a bet on Iger to turn this around in a very short period of time, by the way, and hire a successor in a short period of time, I think the level of execution risk is too high. I would not be a buyer of Disney at this point. I think that it's going to be Iger has not been one who has groomed a successor in the past. Who's to say that he's going to be able to do it in a truncated period of time now? And frankly, while the company is under fire, it's no doubt one of the most valuable franchises in the world, most recognized brands. But I think that this is going to be a tall task. And frankly, it's not going to be Iger that turns around this company. It's going to be his successor. And I feel like if Disney is going to go ahead and find a successor, find it now. Why waste 2 years of Iger potentially mucking things up before finding the real successor to go ahead and take this company forward?
Yeah, it's interesting to see, like, he's the only guy who can do it, I guess, you know? I mean, really. David, real quick on oil. You were so spot on oil going to 100. This morning, hitting a new low for the year yesterday, following reports that OPEC is now considering increasing output. Officials will discuss the change at the OPEC Plus meeting happening next month. David, price of oil at $80 a barrel right now. What are your thoughts on where oil is going in the face of all these different moving parts, like new COVID cases in China, as well as OPEC changes in production?
So recession is going to go ahead and push the price of oil lower, I think, in the short term. In the longer term, or in the medium term, I should say, OPEC is in full control here. And I think the most sad part of this narrative has been and will continue to be the Biden administration's veiled attempt to go ahead and somehow curry favor with the Saudis, when in fact the Saudis couldn't care less about our administration. They've been offended to the point of no return, I think, at this point. And I think they are showing Biden that no matter what he does, that they are in absolute control of what happens with the price of oil, the production of oil, and so on and so forth. What happened with Khashoggi and the related pardon is just, it's telling incredibly. And by the way, last thing on this point, it is incredible to me that we being the presidential administration of this country, will continue to look for oil everywhere else in the world, no matter how difficult those countries are, rather than supporting the production of oil at home. It is crazy to me.
Yeah, it is crazy. I mean, look, oil prices are up relative to when he started selling oil from the strategic reserve. I mean, what kind of a policy is that? He's going hand in hand to the Saudis and to Venezuela to push through his climate change agenda here at home. David, real quick before you go, has the FTX situation destroyed the opportunity to look at crypto as an investment? Where are you on that? I know you were looking for regulation the last time we spoke.
Hell no. FTX has not destroyed crypto. FTX was just a middleman. FTX was just an exchange. It was a centralizing authority. Never put your money in the hands of people that you don't know enough about, don't have transparency on, and potentially don't trust. That's the rule, and that was the lesson learned from FTX. Obviously, a very, very, very costly lesson for so many, unfortunately. But certainly, this is not the end of crypto. Bitcoin and Ether have not been, broken in any way. They will march forward, and their dominance will go ahead and continue to grow.
All right, we'll keep watching that. David, we'll talk with you along the way. Thanks very much. David Tawil joining us.
Thank you,
Have a
Maria.
happy Thanksgiving. We'll see you soon.